Afternoon, everyone, and welcome to the Monetary Policy Forum. I'm Ketio Mavundla, and I'll be your program director today. Now, I'm told to whom the task is given, much responsibility lies. So allow me to take responsibility over some quick protocol. So in the likely event of an emergency, please note that we do have emergency exits situated just right behind me, as well as the back end of this conference room. And then just to note for the Q&A session later on, for those of you in this room, we do have roving mics, and so you'll be assisted as you raise your hand. And the final point is that we are live streaming this event, and so we'll actively monitor the chat for any questions that come up for the Q&A session later on. Now, as we move to the main part of this event, I think it goes without saying that the combination of fairly established as well as newly arisen risks continually test the resilience of global macroeconomic conditions, and all of which, alongside domestic factors, have implications for our economy's trajectory, which is why we're all here today to get a sense from the SARB, its thinking around some of these factors. With that said, I'd like to welcome the members of the MPC and call on the Governor, Lesitsha Kganyago, to officially open this event.
You forgot something. Good afternoon, everyone, and welcome to the launch of the first edition of the Monetary Policy Review. This will be one of the two national monetary policy forums that are scheduled for this year. When we last met in October 2022, we highlighted the elevated inflation risks confronting both the global and domestic economies and the challenges that come with soaring inflation. Globally, you are having a public that has become intolerant of high inflation. You've got a generation of people who do not know what it is like to live with inflation higher than 2%. They are actually used to inflation closer to zero. And actually, we're also used to interest rates that had been so low historically and closer to zero. And this rise in inflation globally has become as a shock to the public, and the response from central banks meant that central banks became the focal point. What was initially thought as a temporary shock to inflation, where inflation rose and remained elevated, has proved to be more persistent than initially thought, although it has begun to moderate slightly. Policymakers continue to navigate the challenges brought about by high inflation and low growth. This is not any different from the domestic picture, where inflation remains well above the upper end of the target range, although it has moderated somewhat. Concerningly, over the past few months, we saw inflation move from 6.9% in January to 7% in February, and then 7.1% in March. We still hold the view, though, that the peak that we saw of inflation last year was indeed the peak. In terms of growth, the outlook is not promising either. As you will see shortly with the presentation, we expect structural constraints to continue to weigh down on GDP growth over the short to medium term. The South African Reserve Bank was also confronted with inflation surge, which our Monetary Policy Committee decided to confront with resolve. The aim of policy has been to anchor inflation expectations more firmly around the midpoint of the target range and to increase confidence of attaining the inflation target sustainably over time. We remain committed to bringing inflation back to target. For inflation declining back to target means better anchoring of inflation expectations, and lower inflation begets lower interest rates, and thus the cost of finance in the broader economy. At this stage, I would like to hand over to Witness Sambanegavi, the head of the Policy Development Unit of the Economic Research Department, who is going to take you through a slide presentation of the book that we released, the Monetary Policy Review. It's a book like this. When you get out of here, you can always grab it outside. It makes for very interesting reading. Witness.
Thank you, Governor, for the introductions. And good afternoon, everybody. My name is Witness, as the Governor mentioned, and I'm going to take you through the presentation today. So I'm going to start by just giving you a sort of a highlight of the key points that we think you should be taking away from this report. And then, of course, I will sort of go into some detail to try to explain our thinking. Okay. So to begin with, so we just, as by way of highlights, we want to show that we make the case that the global inflation remains elevated and also persistent. And of course, if you look at what's happening to global growth, actually it has weakened quite significantly over the last 2 years. And of course, in response to this high and elevated inflation, we have seen central banks across the globe, especially in the advanced economies, raise their rates substantially. But given the recent developments around bank stresses in the US and the UK, the future path of rate hikes has become a bit uncertain. And the other thing that we want to touch on is the fact that when we come back to the domestic economy, actually growth in South Africa continues to be underpinned by weak or by structural constraints that we experience. And of course, we all know that one of them, especially, I think it's affecting all of us, is the load shedding. Despite these structural constraints, actually, there are some sectors that have shown resilience in our economy, and one of them is households. Household growth or consumption growth has continued to remain positive, supporting the growth in the economy, and also, of course, investment has remained quite robust despite the challenging environment. And of course, given this robust growth in sort of household spending and investment, whilst we are seeing constraints on the production side, we have seen a pickup in imports, and as a result, the current account actually has deteriorated, is now in deficit, and we expect it to remain in deficit. And coming to inflation, we believe, as the Governor just mentioned, that headline inflation peaked sometime last year when it reached 7.8% in July, and we have seen it moderate somewhat over the last 6 months. But the recent data points that we have seen, again, as the Governor mentioned, gives us reason to think that we are on a long road to midpoint. it's not going to be sliding down the slope. I think it's going to be bumpy. And of course, we know that the risks remain elevated. So now I'm going to try to go into some detail on each of these points, beginning with our view of global growth, where we see, and inflation, where we see inflation is quite elevated, but there are indications that it has peaked, or it peaked in the last half of last year, the second half of last year. And of course, when you look at growth, you see that growth has become sort of weaker, global growth that is. The blue bars here are showing what we call the trading partner growth, which is our measure of global growth, looking at our trading partners. But then, of course, the red line there shows the IMF projections. And here we see that even by the IMF projections, global growth is seen much weaker compared to the black dotted line, which is the average over the last decade. And also we expect global growth to slowly pick up. And I think according to the IMF, even by 2025, we'll still be below the average for 2010 to 2019. So that's obviously concerning that we have inflation elevated, but growth much weaker. So trying to go into a bit of detail, here we see what's happening in terms of inflation in the advanced economies. Headline inflation remains elevated across advanced economies, but there are indications that inflation has peaked, as we can see from the charts here. And of course, if we try to then dig a little bit more to say, well, what's happening really? We see that food and oil inflation has really come down in most advanced economies, and that's explaining the trajectory that we are seeing of receding inflation, at least the headline inflation in these advanced economies. But if you go one step further and dig a little bit deeper, we see that actually core inflation or underlying inflation remains elevated across these advanced economies and also across emerging market economies. Yes, in some countries like the US, there are indications that core inflation may have peaked, but it remains quite elevated. And we know that core inflation generally is a slow-moving variable, unlike headline inflation, which is much more influenced by things like food prices and oil prices, which move a lot more frequently. So this is a sort of a worrying picture that core inflation remains elevated. And of course, it does it's a concerning picture for central banks because they need to figure out how to bring this inflation back to closer to the target. And of course, why, again, trying to look at why this core inflation remains elevated, we try to dig a little bit at labor markets and also other markets, where we see that actually the demand-supply imbalance persists in several markets. Here we just sample a few, looking at, for example, the US labor market, the Japan, German, and UK, with these advanced economies, where we see that compared to the average for 2010, the ratio of unfilled vacancies to unemployment is quite elevated, which means there is excess demand for labor, or the supply of labor is much more restricted compared to what we would consider as the norm. And of course, we know that when the demand for labor exceeds supply for labor, that exerts pressures on wages. And we know that, of course, pressures on wages ultimately will lead to pressures on prices. So that's why central banks are concerned about this development. And if we also look at services inflation, here we see again that inflation is still very, very high or elevated across advanced economies, which again signifies the fact that the demand and supply imbalance persists in this market as well. We don't show here the goods market, but it's also the case that the pressures are still there in the goods market, even though they have subsided somewhat. And also we see that market expectations remains above the 2% inflation target in advanced economies, which is again a source of concern for central banks. So given this kind of environment, central banks have had to respond by raising interest rates to try to stem the spread of inflation. And of course, here we look at the left-hand side chart. We see what has been happening in the advanced economies. some strong increases in interest rates, and the same applies to emerging market economies as well, except for maybe less so for India, but most of them, they have really hiked their rates quite substantially over the last couple of months, let's say the last 18 months. And of course, as a result of these rate increases and of course elevated inflation, when you look at what has happened to real policy rates, we see that real policy rates are increasingly becoming tight in many jurisdictions. And of course, here we try to show you two ways of measuring the monetary policy stance. One could look at, for example, the ex post measure, which is you look at current inflation and current interest rates. But the typical way to measure a monetary policy stance is to look at the 1 year ahead inflation expectations, which are the blue bars, and then the current or the ex post measure is the gray bars. Here we see that if you were to look at the ex post measure, we see that for many advanced economies, we would say that monetary policy remains very lax because the real rates are still negative and below the neutral rates. But if you look at the ex ante measure, which looks at 1 year ahead inflation forecast, here you see that actually for most of the advanced economies except for Japan, you see that the rates have become tighter and actually above neutral levels. If you look at emerging market economies, the picture is more or less the same. Rates have become tighter generally when you look at the 1 year ahead forecast. And of course, in addition to the tightening of monetary policy stances, here we also see that the financial conditions have tightened somewhat over the last couple of weeks, and this follows the recent bank stress conditions, especially in the US and also in the EU. And of course, the tightening of these financial conditions actually sort of complements the efforts by central banks to combat inflation by further tightening financial conditions. And of course, what has also helped maybe in the recent months is the fact that exchange rates have sort of somewhat recovered after depreciating substantially over over much of last year against the US dollar. We have seen a lot of, for many countries, the currencies have sort of recovered somewhat. And of course, we know that with somewhat stronger currencies, that reduces the exchange rate pass-through that's helping to combat imported inflation. The combination of tightening financial conditions and of course rising interest rates and high inflation has actually exerted a lot of pressure on growth. Here we see that global growth is much weaker, and actually if you look at the outlook, it's also not that promising. The outlook is fragile. That is true of advanced economies, and that is also true of emerging market economies. Now turning to the domestic economy, here we see that yes, growth in South Africa as well is fragile, but if you try to dig a little bit deeper, you see that the reasons for the fragility might not be exactly the same as we see in the global economy, and we are going to try to explain that in a few slides. So here the first point we just want to make, to put across, is that because of the challenges that we are seeing in the domestic economy, GDP growth has been downgraded markedly, and also has the potential growth, GDP growth. And to try to understand why this has been happening, well, the biggest reason why there's been this downgrading of growth and actual growth and potential growth is largely due to electricity constraints that we are facing as a country. And here we see on the left-hand side chart that if you look at the red section there, where we are showing total unplanned outages, this has been increasing sharply over the past year. And of course, if you look at the energy availability factor, we see that it has actually come down quite a lot, which means a lot of our generating plants are offline most of the time, and therefore we cannot provide adequate electricity to support economic activity, which explains the downgrade in our projections. Now, if we also look at another challenge that we have faced over the past year, and I think we are going to face it in the medium term, is one of logistics in general. We know that we have seen over the past couple of years that there has been a deterioration in rail freight infrastructure, but also port performance has been quite poor. And of course, as a result, we have seen that since the pandemic, because of the continued deterioration in transport infrastructure, particularly rail, we have seen a lot of freight move from rail to road. And we know that road freight is inefficient when it comes to the movement of some of the commodities that we are producing. And also our port systems were designed to handle cargo delivered by rail freight, not by road. So there are a lot of inefficiencies that we experience when we move a lot of our goods through road. And so that's another constraint in terms of our ability to grow. And sort of looking ahead, we see that in the last year, our estimates will show that we had 157 days of load shedding. And of course, we already this year, year to date, which is we are just in April, we are already at 108 days of load shedding, which is probably more than 60% of our load shedding last year. And our expectation is that we are going to experience somewhere around 250 days of load shedding this year. And of course, we'll continue to experience load shedding, but on a declining scale in the medium term, largely because we believe the energy reforms will kick in and we'll begin to see some energy flowing into the grid sooner over the medium term. But the effect of this large-scale load shedding actually can be demonstrated on the right-hand side, where the sub-estimates show that in 2022, actually, GDP could have been closer to 3% had we not had load shedding, because we believe load shedding shaved off about 0.7 percentage points from GDP last year. But if we come to 2023, it's even more worrisome, because we see that here we're actually projecting 2 percentage points drop in GDP just because of load shedding. So that's a very concerning picture. However, everything is not dire. I think we see some resilience, as I mentioned earlier, from the demand side of the economy, particularly from investment, private investment, and also from household consumption spending. And of course, when we look at investment, private investment, of course, is the main driver of total investment in the economy, and was the big driver of investment over the past year, in 2022, which allowed for a 4.7% increase in investment. We expect investment to remain fairly strong, the private investment, over the medium term, bouncing around 2.5% per annum. And we think this investment is going to be supported by, again, the energy reforms, the implementation of these energy reforms, and also firms trying to mitigate load shedding by investing in other forms of energy. So that's likely to keep investment strong. And on the consumption side, we do expect households to continue to spend, and of course, they're supported by credit demand, which we see here remains fairly strong. And also, I think over the past couple of quarters, we have seen continued recovery in employment, which again should sort of support consumption by households. Of course, also during the same period, we have seen some signs of pressure on households, or pressures on households, as we can sort of see in terms of declining spend on food. But the picture is somewhat mixed, because yes, there has been some decline in spending on food, but also actually at the same time you would find that spending in terms of restaurant spending has actually gone up. And at the same time, we have seen very strong performance in terms of durables. So although they constitute a smaller percentage of total PC consumption, but they actually have been very strong, which is indicated by those yellow bars in the picture there. At the same time also, we have seen that yes, there has been a decline in real disposable income, but actually income growth, but it remains positive. So the fact that our real disposable income is positive and growing, it means that we should expect a continued support to household consumption. And again, sort of looking at, digging deeper again in terms of this expenditure side of the economy, we see that the strong demand in the economy has actually supported growth, and also as a result, because production has suffered from energy shortages, we actually have had to import a lot more. So as you can see, those two, if you look at the left-hand side chart, here we show that the gross domestic product, which is the green, from the pandemic, we saw a very strong recovery in production, but with time, we started experiencing production side challenges, but demand remained very strong, which is now exceeding production by quite a wide margin. And of course, the gap is being filled by imports. And of course, the combination of this strong demand, which is pulling in imports, and depressed depressed exports because of challenges due to electricity and also transport logistics, has resulted in, of course, an increase in imports. But together with the fact that commodity prices have been coming down, we have seen that the result has been a deterioration in our external accounts, where we see that the trade account, trade balance has actually come down significantly, and also the current account itself has come down significantly and is now in negative territory, and we actually expect that the current account will remain in deficit over the medium term. At the same time, the exchange rate has come under a lot of pressure, and of course here we see that the real effective exchange rate is depreciated markedly, and the gap is actually not closing over the medium term. And the concern with this kind of posture is that when the exchange rate is so depreciated, the result is that it actually feeds into inflation via the exchange rate pass-through channel. And this has been a big factor explaining the sharp rise in and persistence of inflation in the domestic economy. So now shifting to inflation, here we see that domestic inflation, headline inflation remains elevated and also persistent, and of course, trying to, I think the picture is very sort of self-explanatory. It does show that a big driver of the sharp increase in headline inflation has been that red line, which is non-core inflation, and this has to do with food and fuel mostly, and that has pushed or pulled the headline inflation higher. But at the same time, we have also seen that core inflation has been rising, and we are going to explain a little bit more of what's going on there. But I just want you to sort of take a look at that bulge that we see in around 2024. That has to do with the electricity, the sharp increase in electricity tariffs that were announced by NERSA in January. So that's pushing the non-core inflation higher around in the outer period. So when it comes to domestic factors that are driving inflation, so if you take a sort of a step back and try to understand what has been happening to our inflation, as I mentioned, we initially, inflation was driven by external factors, which is fuel prices and also food prices, because global food prices were quite elevated for most of 2022, maybe beginning in 2021, feeding into 2022, and we saw that domestic prices started picking up as well, even though we have had a bumper harvest. But what we have also noted now in the latter half of 2022 was that, yes, global prices started sort of coming down, but domestic food prices continued to creep up. And of course, the reason for that is that the domestic factors actually ended up taking over as the global factors were subsiding. So here we just show on the right-hand side that milk, cheese, and eggs inflation has really skyrocketed over the last half of the year. But if you look at the left-hand side chart, here we see that bread and cereals, and as well as meat, are major drivers of domestic inflation. But we have seen the green bars, which is on the right-hand side, and also the blue bar, which is vegetables. And I'm going to sort of try to explain that in a few slides. But the vegetables largely reflect the heavy rains that we've experienced over the last year, which have affected crop harvest and some of the root crops, sort of affecting the yields, and as a result, with supply constraint, prices have actually tended to go up. So food inflation, which has been a major driver of inflation over the last 6 months, remains an upside risk in the outlook as well. And we worry that that might continue to feed into headline inflation. And we just saw that, yes, we have been, if you look at the left-hand side chart, our projections, we have consistently been surprised by food inflation. We already expected in September 2021, we expected food inflation to come down. It actually didn't. And then, of course, in March 2022, we expected food inflation to flatten out and then slow down. It didn't. In September last year, our projection was for food inflation to rise a little bit, and then, of course, to come down. But actually, again, it's surprised to the upside. And now we are sitting around 14% if you look at month on month. And sort of the surprising bit is that one would have expected, as I mentioned earlier, that with global food prices coming down, we should be seeing the benefits of that in the domestic economy. But we haven't for the two reasons. First, the rand has weakened substantially, so therefore we haven't been able to realize the benefits from slowing global food prices. But the second point is that the domestic factors, which has to do with meat, and then of course, because of the foot and mouth disease, and also the high feed costs, and then the other agricultural considerations, together with load shedding, they have actually kept food inflation elevated. Now looking at core inflation, which is another component that is driving headline inflation higher, here we see that, yes, core inflation actually has surprised on the upside, and we expect core inflation to continue to rise for a couple of quarters before it starts coming down. And of course, if you try to break down the component into the components of core inflation, the red line here is core goods inflation, and the blue line is services inflation. Now, if you look at the dotted lines that you see in the picture, hopefully they are visible. During the September period, the expectation was that core goods inflation and services inflation would sort of converge and sort of peak somewhere around 5% and then start coming down. But what we see is that actually that is not what transpired. What we see is that core goods inflation is actually escalated quite sharply. And this is largely because of two factors, largely because of global goods inflation, which have been elevated and of course aggravated by a weaker exchange rate. And of course services inflation came out lower than what we had projected, and that's largely because our render assumptions proved wrong, so render inflation has remained much lower than what we had projected, and at the same time, the medical inflation prices increased by less than what we had projected, so that explains why services inflation is lower. Okay, so that's pretty much what I was speaking to now. That core goods inflation has been higher, largely because of global goods inflation, but also the exchange rate. But the other factor that is also, I think, interesting is that if we look at the demand, as we mentioned earlier, that the domestic demand has been strong. You can actually see on the right-hand side, on the right chart, which is a sort of non-durable spending, actually has been quite robust. And one interesting component there is transport equipment, which has remained strong, I think, for 5 quarters in a row. And this is, we've seen like there's actually excess demand for vehicles at the moment, and that has sort of helped to keep household spending up. And as a result, I think it's allowed sellers to actually push some of the price increases. Coming to services inflation, here we see that, yes, services inflation continues to gradually creep up. As I mentioned earlier, rental inflation or housing inflation moving sideways at the moment, but medical inflation creeping up. And of course, we'll also see restaurants and hotels inflation up, largely because of spillover effects from the high food and fuel costs, and also, I think, strong demand. And there has been strong demand for restaurants and hotels as well. But if you look at our view for services inflation, we do expect it to continue to creep up. And there is one of the reasons, of course, is on the right-hand side where we see if you look at the diffusion index, here we see that the share of the basket that is growing above 4.5% is actually growing, which suggests that inflation for this category will continue to grow. So now, the other concern or considerations that we have to look at is that, yes, part of the drivers of services inflation is inflation expectations, because these affects, they affect the wage demands and things like that. So here what we see on the left-hand side is that inflation expectations have actually become a lot more elevated over the review period, which is the last 6 months. We are looking at the 2 years ahead inflation expectations. For unions and for business is actually above 6%. For financial analysts, we are closer to what the SAP expects. And because at the moment, I think the SAP focus show inflation in 2 years' time around 4.6%. But here, business is projecting inflation in 2 years around 6.2%. And that's obviously concerning, because the business people might be making decisions based on this view of inflation 2 years hence. And on the right-hand side, we're just showing what has been happening to inflation expectations if you look at the distribution of those expectations. Here we see that, especially if you look at the blue line, which is the current, the 2022, what you see here is that, well, we actually have two features that are worth noting. One is that it's bimodal. Oh, sorry, trying to find the pointer. So we see that in 2022, the 2 years, the inflation expectations, they are bimodal, which means you have more or less a split among business people. Some will believe inflation will be around closer to 5%. Some will believe inflation will be above 6%. And of course, the other feature which is worth noting is that we actually have a fatter tail, the right tail for these expectations, which means there's a big, share of respondents who view, who think that inflation would likely be above 7% in 2 years' time. And of course, another concern that we have in terms of the trajectory for inflation has to do with load shedding. And here we just sort of put together a couple of headlines just to show the concerns by business people around the impact of load shedding. So load shedding is going to raise costs of businesses, and obviously businesses are likely to pass through those costs to the consumer. And of course, we have a box in the MPR that tries to calculate the impact of load shedding on headline inflation. But I think these headlines are sort of self-explanatory. In light of these developments that we've seen and the persistent risks of inflation, we see that the repo rate actually, the MPC raised the repo rate to above 7%, which is what we term the steady-state neutral rate in terms of the nominal rate. So now the repo rate is around 7.75%, which is higher than that. But if you were to look at the real repo rate, well, what we see is that the real repo rate is still below the steady neutral real rate, which is 2.5%. And the dots that you see there, the black diamonds, they just, because the forecast was done before the MPC, so we are trying to incorporate the decision of the MPC to see where the real repo rate would be if we were to incorporate that decision. As you can see, looking at 1 quarter ahead, which is the dot at the top, we still remain below 2.5%. Of course, the real repo rate is closing in on the neutral, but we are still below that at this point in time. So in terms of where to from here, here we see, just try to look what markets expect central banks to do over the coming few months or quarters. In terms of advanced economies, here we see that the markets actually expect central banks to still raise rates in the advanced economies, but the pace has actually come down, and the terminal levels have actually come down, largely because of the tightness in the financial markets that has happened since the SVB bank failure, and the impacts also that reverberated in the Eurozone. So for the US, for example, we see the black line, which is after 1 April, shows some expectation for rate increases up to May, and then of course rates should be coming down after that. In the Eurozone, something similar, probably to rates to peak in around September before they sort of start coming down, and the same for the UK. So what about in EMs? Well, in EMs, so the expectations are somewhat that EMs should be pausing or largely pausing on rates, and some of them might actually start to lower rates. For example, Brazil, which hiked a lot over the last year and a half, is expected to start reducing or lowering their repo rate around the third quarter. Countries like Mexico, India, some small increases, more like fine-tuning expected. Now, looking at South Africa, what markets expect of rates in South Africa, here we see that in January, the expectation was that interest rate would peak around 7.25%, and then sort of start slowing or coming down from there. But what we see then, of course, before the SVB failure, the expectation was that the rates would rise to around 7.75 before they start coming down. But as of 21 April this year, we see that the markets, following the decision by the MPC to raise the repo rate by 50 basis points in March, the expectation is that the markets expect another 50 basis points hike, spread over, I think, 2 meetings, and for rates to remain steady or elevated at that level before they start coming down a year from now. Okay, so just to sort of summarize, we see here that global inflation, as we said, remains high and persistent. The question is, of course, is policy being effective? I think that's a question that we might want to think about. And of course, the other interesting bit is that we see here that we expect global growth to slow down. We expect financial conditions to remain a bit tight. But if you look at what financial markets are projecting, they actually see rate cuts coming in as early as maybe around June for countries like the US. And now the question is, of course, if that, given those expectations, are financial conditions going to ease prematurely? And if that happens, what does that mean for inflation? Because that might actually go counter to what central banks expect or would want to see. And coming back to the domestic economy, yes, food and core inflation remain sticky, and they are sort of keeping headline inflation elevated, and we don't quite see the risks receding as yet. And of course, if you look at the real repo rates, around neutral region so far, but we see that, of course, inflation pressures persist, and also inflation expectations are quite high. The question is, where are they going from here? And the other sort of interesting question to ask is whether the fact that we have had headline inflation away from the 4.5 midpoint for about we expect it to be away for about 18 quarters, given our forecast. Is that one of the reasons why we are seeing some element of de-anchoring in inflation expectations? I don't know. Maybe that's something that we need to sort of do some work on. Governor, with that, I think, thank you. We're done.
Thank you very much, Witness, for that presentation. I know there are people also online using our various social media channels. Welcome as well. I now open the floor for questions. I will start here in the room, and I'm sure somebody is watching the online stuff. There are two very active ladies at the back with the roving microphones. So if you raise your hand, they will bring the microphone to you. Witness, looks like you did a very good job because there is only one hand at the moment.
Governor, good afternoon, Governor. Thank you for the presentation. Tafadzwa Chipanguza from the Steel and Engineering Federation of Southern Africa. My question, Governor, is I've been debating in my mind if it's philosophical or technical, but the question is if companies are investing to meet an immediate survival need, in the sense of investing in alternative energy solutions to mitigate the load shedding, does that still meet the investment criteria? Or can you still call it investment? And the reason I'm asking it as well is that if one is then to take the departure point that they are investing in immediate survival, and it's not investment in the classic sense, might that not lead us to arrive at an incorrect interpretation that the demand side, being investment, is holding up? And maybe with that, are there any other variables that would support that the investment side is holding up outside of them just investing in immediate survival? Thank you, Governor.
Let me see if I've heard you properly. The acoustics are not very good. If companies are investing in alternative power solutions and those power solutions are not renewables, but like the noise we are hearing outside, does still that count as investment? Is that the question?
But it's more to say they are investing in immediate survival. So the question really is that
in immediate survival?
Yeah, to just produce, right? So they are investing just so that they can to mitigate load shedding, so produce. So the question really is that, can we still class that as investment in the classic sense of companies investing to grow when it's really just for immediate survival? Because the point then being that, might that not lead us to an incorrect assumption of the demand side of the economy holding up when companies are only just really investing to survive immediately?
Okay.
Thank you.
Thank you very much. There is another hand. If you stand up for the benefit of our social media.
No, thanks, Governor. My name is Landiwe Mahlangu. I just want to, if you could explain this. You know, the food prices globally has been on the decline, flattening on the decline, and yet we have a situation where at home that actually food prices has been quite a factor in terms of the rising, inflation. Could there be any other explanation except for the exchange rate for this apparent, divergence in these trends in food prices? Thank you.
Thank you very much, Governor. Sam Puru from Black Insurance Advisors Council. I have two questions for the panel there. The first one is that I was at PEP store today, and then what I've noticed that there are foreigners who come to the country with their own products, and they sell the products within this country, but the income that they generate from this country does not go to the bank. They use the cash sent at PEP stores, ATMs, whatever. And as I mentioned that there is a structural impact on growth in the economy. Is that not affecting the economy because they come with their own products, they sell them here, they don't bank. They're actually treating our country as a sort of a flea market, because it's only the flea market where you sell the products and pocket your money and go home. But that's what happened. Now, the second question that I'm having also is that if we talk about advanced economies and emerging markets, what criteria has been used? Because we have been told that China is one of the biggest economies, but it keep on referring it as an emerging market. Thank you.
Good evening, Governor, and to the panel. I'm Diane Charavanya from Wits University School of Economics and Finance. And my question to you is, so from the previous discussion, we've seen the devastating effects of load shedding on the economy and inflation. So I wanted to ask, there's been a lot of talk about the just energy transition. So I wanted to ask, do you think this is a viable solution for combating load shedding? And if so, does the South African Reserve Bank have a role to play in facilitating this transition?
I got the bit that you were saying now at the top. I couldn't get what the question is.
So in light of talk about a just energy transition towards green energy,
Yeah.
is this a viable solution for load shedding? And if so, does the Reserve Bank have a role to play in facilitating this transition?
In facilitating the just energy transition?
Yes.
Okay. Okay, let's take the last question here. In this round, we will take other questions.
Thank you very much. My name is Ubongan Mahlangu. From the South African Youth Council, SAIC, and I have a very simple one, is in terms of the South African Reserve Bank Act, Section 10, F1, I just want to know to which extent has the bank itself and government been implementing or activating that section of the Act?
Okay, I will have to read that section again. But there is nothing illegal we are doing. I can assure that. But I think that Section 10F refers to some lending to the government, if I remember well. Somebody will check it for me just now, and they will read it back to me, and then I will tell you exactly what we are doing. Well, the first question was premised as being a philosophical question. It's actually a statistical question. It goes to how we measure investment. So, if you are a business and you buy capital goods, in this case, say you've bought a generator, it is investment. It counts towards investment. And you ask the question, if you invest in renewables, yes, if you invest in renewables, it will also still count as investment. The difference is the investment in renewables is more sustainable because it's renewable, whereas if your interim power solution is still one based, like the one we hear outside, based on the hydrocarbons, you are still also exposed to the price of oil. And so you have made the investment, but the operating costs from that investment could be higher, which could suggest that very soon it will affect your cost structure, and thus you might end up being faced with a situation where you then try to pass that to the consumers. And you might do that, and we have seen evidence of that. But if your competitors have decided to invest in renewables, they are going to eat your lunch. Because you see, they then are not going to be facing the other running costs that you are faced with, and that is the distinction. But there is a more fundamental question that might just be coming here, that what we have been seeing in the investment, because we have had such a protracted period of contraction in investment, the current investment drive is almost just restoring the investment stock to almost what it was before, and we have not yet grown the investment stock meaningfully. So that is the challenge that we would face. Where that turning point is, I will ask one of the clever chaps from the Reserve Bank to tell you. So question about food prices, and we had a slide on this, that global food prices have been declining, but food prices in South Africa have continued to rise. One part of it is the exchange rate. because of the exchange rate. When you convert from the dollar prices into rent prices and the rent is weaker, then it follows that the price is not coming as fast if it comes down at all. But the headlines that were flagged in the presentation says that there might be other things that are driving food prices. And those have to do with the costs in the food chain, food production chain. As you had seen that the impact of load shedding had resulted in people from poultry producers to milk producers having to lose product, dump product. And that loss of product means that they had experienced costs that they didn't expect. And they are going to be forced to try and recover those costs or go out of business. And that attempt to recover those costs is going to be pushed into the food products that they are still able to sell, and that would be contributing to inflation. And in our attempt to estimate the impact of load shedding on inflation, it had to do with some of those things. And our estimate was that inflation this year would have been 0.5% lower if we didn't have inflation. There are lots of assumptions that we must make there to try and estimate that, including the extent of the load shedding, including which industries it impacts most. But that is what we had seen thus with food prices. There was a question that's a little bit complicated, and let me see how I answer this, which deals with foreign goods that come in here and then they are sold and the people take the money out. It's actually an interesting one. The fact that there are foreign goods coming into the country suggests that we are not producing enough to meet the demand. Where do we see that evidence? In the current account deficit. More specifically, the trade component of the current account deficit. So we are a country that is not producing enough of what we are actually having to consume. Of course, many countries are in that phase. Depends on what also you produce. We are very good digging stuff out of the ground and selling it elsewhere, and that is what has been driving our exports. I can't say to what extent the goods that had come in, the money does not go through the financial system, but the bulk of it would. I mean, unless you are referring to stuff in the informal markets that people do not go through the banking sector. But that also says something. How did the goods come in? Because if the goods come in, they are declared at the port of entry. And when they are declared at the port of entry, there would be tariffs, VAT, there will be all sorts of taxes that are levied on those goods. And part of it is to ensure that there is fair trade, but part of it is also that the goods that had been produced here would have been vettable, and if the food had the goods have come from elsewhere, we impose VAT on those, and that is how the thing goes. I find it strange because many times people talk about these goods, and they don't talk about the goods in the parking lot here, because there are lots of goods in the parking lot here that had come from elsewhere, and we are quite happy to enjoy those goods and sometimes even show off that look what I have just acquired. So we've got to understand in analyzing the economy, we think of the totality of all of these things coming through. Criteria for advanced economies and emerging markets, there are several measures. One of the most common measures is a measure that uses GDP per capita and then says that the countries that have got the highest, this is what they are depicting, and therefore they fall in the advanced economies. In other instances, they would be looking at the extent of industrialization and so forth. And it is possible for countries to move from emerging markets to the advanced economy status. So far, we have not seen advanced economy countries that moved into the emerging market status, but there are also countries that have moved from being middle-income countries and slipped back to being developing economies. They have stopped being middle-income countries, and they have one thing in common. They have adopted terrible macroeconomic policies, and they thought that they are being unorthodox, and they got exactly orthodox outcomes. And that is what we face. But I'm sure the panelists here, if they have got enough time to get onto their iPads, they probably have found the criteria and they might update you. Just energy transition. It's, the J in the JET just stands for just that, just. And you know, a sense of justice is something that is a subject of an agreement as to whether that transition is just or not. And at the moment, there is big debate about whether the advanced economies which have historically polluted the globe are carrying their fair share of the transition to this new energy, green energy technologies. It's a conversation that is taking place. It is a global contestation, but then you narrowed it, which is because you asked what the role of the Reserve Bank is in that. And central banks are designed for a purpose. And they are given a mandate by societies. And globally, we have had to grapple with what role we play as central banks and what the impact of climate change is on our respective economies. And the forum that we participate in is a forum called the Network for the Greening of the Financial Sector, which basically looks at the impact of climate change on the financial sector, because as central banks, we regulate the financial sector, and we must see whether they are measuring the risks correctly and so forth, and also what mitigating steps are they taking. That is one that has to do with the financial sector and dealing with the effects of climate change. Within the Reserve Bank, we had to go beyond just looking at the impact on the financial sector and said, what does this mean for the future evolution of the South African economy and the price formation process in the South African economy? In other words, what would be the impact of climate change on, for example, food production, because that is where you immediately feel it, and what that would mean for the future evolution of prices. So our research agenda on climate change necessarily involved looking at the impact of climate change on our mandates. And we have got a price stability mandate, and we have got a financial stability mandate. The price stability mandate is the primary mandate of the Reserve Bank, and then we had to look at the impact on the South African economy. Just energy transition will also mean that you are going to have different technologies. Initially, when new technologies are introduced, they tend to be expensive, but as the technologies are becoming widely used, the cost of those technologies declines rapidly, and we have seen it with renewable energy technologies that have evolved. Have you read Section 10? Thank you.
Thank you, Governor. Section 10(1)(f) of the SARB Act says that the SARB is able to grant loans and advances, provided that unsecured loans and advances may be granted only in the following cases. So 10(1)(f)(1), an unsecured loan to government of the Republic or to a company referred to in paragraph B, that's about notes and coins, with the approval of the board to any company in which the bank has acquired shares in accordance with the provisions of paragraph D. So I assume that you're asking about whether we have considered giving a loan to government. What should also be remembered is that there are limitations in the law. So you should also read paragraph 13 of the SARB Act. So paragraph 13 of the SARB Act says that the bank may not, 13F, may not hold stocks in government, hold in stocks of the government of the Republic which have been acquired directly from the Treasury by subscription, the conversion of existing issues or otherwise, a sum exceeding its paid-up capital and reserve fund, plus 1/3 of its liabilities to the public in the Republic. So Section 13 actually imposes a limitation on us to lend to government. We do hold some government bonds, part of our monetary policy portfolio, but it is not the policy intent of the SARB to fund government. Right? Again, I repeat, we do hold some bonds of government, but we believe that the way in which Section 10, read in conjunction with Section 13 of the law, is written, it is not the intent of the central bank to fund government, because we think that that is an inefficient way to run economic policy for the SARB to fund government. If I were to quantify the limitations of Section 13F on the SARB, paid-in capital is 2,000 Rand, if I remember. Our liabilities to the public are notes and coins. It's about 147 billion, so 1/3 of that is about 50 billion. So that means that there will be a limitation of about 50 billion Rand if we were to decide that we would like to make a loan to government. 50 billion Rand is about 1% of GDP. It's not going to move the dial one way or another in terms of government that has a debt now of almost 5 trillion Rand, many, many times that. So yes, the law does allow us to lend to government. If there is a policy need, we will consider the matter, but that must be read in conjunction with the limitations that the law provide. And in our interpretation, the spirit of the law says that we are not a regular funder of government. Thank you, Chair.
And well, you said we are implementing it. If we have to implement it, there must be a borrower, in which case this is the government, and they must apply to us, and we will apply our mind and decide whether we want to lend to them or not. And given all of those considerations, the most likely answer is no. We are not going to lend to them. Are there questions online?
No,
Okay.
Governor.
Good evening, Governor and panel, and thanks again for this opportunity. I had a quick look at the review. It seems like the SARB is changing, or would be soon updating, the quarterly projection model to reflect perhaps some shortcomings. Could you perhaps elaborate on that? It seems like the conclusion is that core inflation outcomes might be revised lower if your model currently overestimates core inflation. Is there any implications that this may have for future policy decisions? Thank you.
As we take the questions, Pamela, you better be ready.
Governor Tulem Mhlanga from ABSIP. I wanted to find out, Governor, if the Reserve Bank has looked at the extent of grey listing on the economy, given that we are only just 2 months after the announcement and we've been given some grace, yes, but have you factored that into your stress?
Just pause. The acoustics are not good. And if we are struggling in this room, the people online must be really struggling.
Okay, Governor, is that better?
I don't think it has to do with you, but just repeat the question.
Okay, so my question was, has the SARB looked at the extent of grey listing on economic growth, and what has your stress scenarios shown in that regard?
Good afternoon, Governor and panel. So I wanted to make an observation. So the SARB's Monetary Policy Committee used to be very focused on forward-looking inflation. You would always say that what you do now on monetary policy will have an impact in the next 12 to 18 months. Now, lately, it feels to me that the bank is very focused on the current levels of inflation, because your own forecast suggests that inflation will come down in the medium term towards 4.5%. But there's a very, I would say, almost intense focus on current levels and also on inflation expectations. Now, my concern is if you're going to wait for inflation expectations to go back to 4.5 in this environment where food inflation is at 14 and our administered prices are very high on a constant basis, we might get into a situation where the SARB continues to hike to try and steer inflation expectations down to 4.5, but their own forecast suggests that it will come down in time, and it might result in almost a sort of too much tightening at this point in time. Because if you look forward, the SARB's own forecast suggests we are going to be back in the target band. So if you can just have your thoughts on that. Thanks.
Brian Scanlon, I'm from the Da Vinci Business School. My question is similar to the previous one. It used to be said that it took about 2 complete quarters for a monetary policy announcement to manifest itself through the financial markets into the real economy and into consumer prices. Jerome Powell recently said that with the increased explanation of what the policy thinking is, what he referred to as open mouth operations, that the financial markets were anticipating policy changes, and therefore that there was a shortening in the time from a monetary policy announcement to its effect on consumer prices. What is our experience in South Africa of changes in monetary policy? What is the duration for an effect on consumer prices?
Hi, Governor and the rest of the MPC, Mamagete from Standard Bank. So I've got a set of questions here that hopefully link into one coherent question. But starting with the impact on inflation from load shedding. So the SARB estimates that that is 0.5 percentage points. Do you take into consideration in that calculation what has happened to the rand as a result of load shedding, the confidence effects? Do you have an estimate for that you then put through in that number? And what would that estimate be? The next question that speaks to load shedding again is what is the impact of load shedding on the output gap? So you've got there, you showed that you estimate that load shedding would have a 2 percentage point impact on growth in 2024 or 2023. And then you've got 0.5 percentage points on inflation. Does that suggest that then the output gap would still be a negative impact? And I suppose following on from that would be, what is the correct response to the impact of load shedding on the economy from a monetary policy perspective? Is it for easier policy because the output gap opens up, or is it neutral? How do we think about that?
Okay, let's pause. Give the mic to Pam.
No. So, thank you, Governor. Sorry, I didn't get that question, but I will.
No,
I'll try
I
and
want
get
you to
the
answer
question.
the QPM.
The QPM, the question about core inflation. So what we're trying to explain in that box is that the new model will be focusing core inflation much better than the old model, which means that the errors are becoming smaller, which means it is the best model to use if we're to transition to the new model. So always we're looking at historically how the two models have performed, but the new model obviously would be better for customers. So it depends what the drivers will be in terms of inflation, whether core inflation will be higher or lower, but if the drivers, we pick them up much more accurately in the new model, then it will be easier to focus it, and then the focus errors will be much lower. Thanks.
Okay, no, just pause. There is some negotiation here. So let's just start with Fundi and come this way.
On the impact of grey listing on the economy, yes, we have had a look, but it's early days for us to can say this is what we see in the numbers. We started by interacting with the banks because that is the immediate impact. Once a country is grey listed, generally there would be additional scrutiny on transactions of countries that are grey listed. So if you're taking your transaction through the bank or a foreign bank, and you are a South African entity, they would then apply an additional layer of scrutiny. What was important for us was to ensure that there was no loss of correspondent banking relationships, because those are important for trade financing. So when we think about grey listing, there are some day-to-day implications. Also for remittance, the movement of remittances, it was important to ensure that there were no negative impacts. The feedback that we've had from banks so far is there has not been any loss of correspondent banking relationships. We did get some reports of some slow processing, but that appears to have been resolved. The second area that we looked at was around the funding of South African entities, because that was another worry. Does it mean that because the country is grey listed, you now battle to get access to funds in foreign markets? We haven't seen that impact. However, it doesn't mean that there is no confidence effect potentially that might be related to grey listing, and that is something that we will see with time. We are also monitoring what will happen if other jurisdictions, on the back of the FATF grey listing, also apply their own criteria. So the EU market, for example, has a blacklist of their own. The UK also has got their additional requirements. So we're monitoring quite carefully what ought to happen there. But having said that, we have inquired with the rating agencies at this point in time. It is not an element that they're taking into account in their matrix. Of course, this is in anticipation that by 2025, we would have implemented all of the actions that are on our action list, and that we would come off the grey list. So let me stop there, but work is underway. We are all working with various government departments as well. The Treasury coordinates this work to ensure that we are undertaking the actions to remediate. Thanks.
Thank you, Chair. This issue of sort of potential GDP growth and the role of the SARB and that definition of that phrase in the Constitution, balanced and sustainable growth, is actually quite a difficult set of issues. But let me explain it as follows. So let's assume that under normal circumstances, the car can travel at 100 kilometers per hour. Right? The job of the Reserve Bank is to maintain that speed. If the car is traveling too fast, we can slow it down. If the car is traveling a bit slower, we can speed it up. We don't believe that we can influence the speed over a long period. Right? Other factors, quality of education, roads, infrastructure, policy, determines whether the car can go faster or slower over a long period. So for a particular period, we can speed up the car, we can slow it down. Now in South Africa at the moment, you've got a situation where the speed limit is 100, the car is traveling at 80, and the SARB is slowing the car down. And you say, but why? Why is the SARB slowing the car down? And the reason why we're slowing the car down is because the road conditions have deteriorated so much that it's dangerous to drive at 80. So we've got to slow it down. That's the very simple answer. Load shedding reduces our potential GDP. Load shedding reduces the speed at which the car can go safely. And so it is the unfortunate job of the central bank sometimes to slow the car down so that it doesn't crash and it can still drive safely on a road, even though we're driving significantly slower than 80 or 100. It's not a nice job to have, but that's the job that we've been given in terms of the Constitution. So yes, load shedding does detract from the capacity of the economy. Load shedding does mean that there's lower production, that you do get imports, that it does result in a weaker currency, all of those kinds of things. And notwithstanding that, we've got the job of trying to slow the economy down, because if the car is moving too fast relative to those conditions, it could crash and cause, in the words of the Constitution, unbalanced and unsustainable growth. So it is the correct policy, in our view, to use load shedding or to take account of load shedding in the setting of monetary policy, because it does detract from potential growth and therefore our interpretation of balanced and sustainable growth. Thanks.
Thank you very much. Let me take the two questions. Are we more current-looking rather than forward-looking in the transmission mechanism? So the one thing that's really interesting about the US is that, there are two sides to the transmission mechanism. In many countries, when we say that you have 100 basis points increase in the interest rate, the effect of that takes anywhere between 12 and 18 months. And that's really based on empirical work, and that effect is not truly in 18 months. It starts almost immediately, but the full effect is felt in 18 months. But there's another complication to this, and nowadays central banks talk more about financial conditions. And one of the frustrations sometimes of the Fed is that even if the Fed tightens, but other variables loosen, like equity markets go up, the yield curve goes down. So despite the tightening of the federal funds rate, the actual financial conditions in the Fed, in the US, is easing. And I think that's part of the problem. So that this disconnect comes, the Fed wants to tighten, the markets think something else, there's a bit of a disconnect, and the Fed tightens, but financial conditions ease, so the Fed has to even tighten more to compensate for the easing of the financial conditions. So I think from a traditional monetary policy view, I don't think the legs have changed. I think that how markets think and what happens to kind of financial variables in the market make the management of monetary policy more important. So we have to look at what happens to other interest rates in the economy, equity markets, asset markets, and what the overall effect of that is combined with our interest rate decision. Now, I think that, it's interesting that is a perception of the analysts that we seem to be more current-looking than forward-looking. I think that, sometimes the dichotomy between current conditions and forward-looking can be a false dichotomy. Firstly, understanding or surprises in the current inflation rate or surprises in the current employment numbers or the GDP numbers is very important information for us about where we think the economy is going. It is the starting point of any forecast. So I think the first thing is that, that we use current information very seriously because forecast, we're on thinner ice. We know what's happening. We can do analysis about what's happening today. But if we are in a situation where we are tightening above what the QPM says, despite the fact that the QPM says you'll get to 4.5% at the end of the forecast period, our view is that in order to get to that 4.5%, what the QPM is not picking up is a few things. There are upside risks. Maybe we take a view that we're more concerned about the misalignment of the exchange rate. We take a view that inflation expectation surveys show that there's a risk of it becoming unanchored. So I guess it's the current data, the stickiness of inflation currently, along with our view that despite the fact that we think we're going to get into target with 50 basis points, there are too many upside risks, and those upside risks are what define our forward-looking nature. Thank you.
Thank you very much, Rashad. I think that there is the thing, when we talk about the forecast that is there, I'll tell you what the sweet spot would be. The sweet spot would be all of you just accept our forecast, right? Because then if you all accept our forecast, then that is where expectations are all converging. But you are not going to, right? Because you know that our forecast, just like yours, is based on assumptions about the current conditions and assumptions about how conditions evolve going into the future. So we are all forced to put the forecast. There's interesting data in the MPR that compares our forecast with that of UCHEPS in the market. It makes interesting reading because all that it says is that the South African Reserve Bank is less wrong than you are. It didn't say that we are right. So that is what we face. And bear in mind that our forecast includes the model-determined policy rate path. And so you've got to be cognizant of that if that path is not taken, then that forecast is not going to be realized. The interesting thing is that it's not the first time that we took in this era that we took decisions that are different from the model, and we decided to do more than what the model did in terms of tightening. If you jog your memory back to 2020 and early 2021, you would realize that we were cutting rates faster than the model was doing. And it all had to do with a risk-based policy. We got to take a view about the balance of risks and which risks might materialize, and we would take the decision. And then you said, well, there is a risk we might over-tighten. That's not the only risk. There is a risk we might under-tighten. So can we weigh the two risks? If we under-tighten, and you chaps discover that, goodness, they have under-tightened and inflation has surprised even higher, they have generated an inflation surprise, and everybody changes their pricing to say that they got it wrong, and inflation comes out higher, you know, of course, what is going to happen. A correction must be made. And when a correction must be made, we will now have to take an even bigger step to make sure that this time we do not get it wrong. At that time, it becomes very costly because you take longer to bring down the inflation, and it will have to come at a bigger cost to the economy. Let's talk about the other risk, which is the one you were interested in. If we had over-tightened and inflation surprises on the downside, aren't we all happy inflation is lower? And then it is an easier thing to correct because we will simply just cut rates and we will not lose any credibility in that respect because inflation has surprised lower, and lower inflation is better for all of us. Sianda? And this will be the last round of questions. Can I see how many hands are up? 1, 2, 3, 4, 5. Those are the last ones.
Thank you, Governor. Unfortunately, not being an online event and being here in person is very different. So we don't have the physical numbers in front of us. Some people did get the review beforehand. My question is related to healthcare inflation. First question is related to healthcare inflation, which you advised was below expectation. And I know that you get your inflation figures on healthcare from the Department of Statistics. What I would like to know, and I'm not looking for an answer at this meeting, is what makes up the core inflation that you look at in your healthcare forecasts that you're getting from the Department of Statistics? Is it contributions from members, the cost of healthcare, the cost of hospitalization, cost of medicine, etc.? Just to understand that. And then the gentleman from the steel industry asked about a question regarding investment. And the comment came through about household expenditure had sort of risen. Could that also be related to investment in renewable or generator type energy costs? Because I think possibly spending has come down in general, but is it the investment the consumer is making in renewable and regenerating energy? Thank you very much, Governor.
Thank you. Witness, just prepare yourself to deal with that cost of healthcare. And by now, I'm sure you have managed to pull out the data about how you categorized advanced economies and emerging market economies.
Thank you. Thank you, Governor. My name is Jablan Moyo. They actually say, or there's a saying that I'll just put America in the saying that says, when America sneezes, the whole world catches the flu. So I'm actually talking about that, having something in mind that somewhere around February or so, you might have seen banks in America falling, if you like. And I'm also thinking of our own position here. And that brings a question in my mind to say, is South Africa ready as a country? So if, let's say, maybe we are faced with such a situation wherein a lot of people are actually doing a lot of withdrawals, are we going to be able to withstand that position? And number two, I think you were answering a question, so you stated clearly that Reserve Bank, you actually been given a mandate by the society. So what's your view as a Reserve Bank on extending the mandate? Seeing that South Africa, in my own view, is actually slowly dying, you know, a silence that we might have seen people losing employments and, you know, this thing of focusing solely on inflation targeting, and yet there is also a scope to increase, you know, on your mandate, maybe looking at issues of employment, putting that as well on the scope. So what's your view on that? Thank you.
Hi, Governor. Zovuyo here from Alex Forbes. I think my question is similar to the one the gentleman just asked. You spoke and you touched on unorthodox tools versus orthodox tools and how the countries that have implemented unorthodox tools have failed, and we've seen that. But I think, again, to the gentleman's point, the reality is our economy, and our local economy specifically, has its own unique characteristics. One being, first, an African economy, but also if you benchmark it against our peers are not experiencing one point that we've spent time on, which is excessive load shedding. And so, again, are there differentiated tools outside of the traditional way of doing monetary policy or implementing monetary policy that are at least in conversation within the policymakers that I think can help specifically the unique characteristics that we are facing compared to our peers and also advanced economies? Thank you.
Sorry, did you say tools outside of monetary policy?
Of the traditional one. So like you will use quantitative easing, for example, you use cutting or hiking interest rates. So are there any other tools that are you thinking of in price stability, output gap, and exchange rate stability that are not similar to what is being currently used in monetary policy by the rest of the world?
Okay, thank you. That's the last one.
Thank you. My name is Michael from ARIT, Multitech Group. My question is relating to technology and mostly energy transformation. I saw the question that been asked and answered by you, Governor, on the energy, I would like to say transformation. But beyond this, there's something beyond it, which is a disruption. And when it comes to disruption, disruption is coming into various sectors, including energy. So when it comes there, when the answer was like, okay, there is a conversation going, but on top of the conversation, should it not be regulations among the conversations and policies so that the SARP can give kind of guidelines, national guidelines or recommendations to the government to implement such a disruptions coming. It's called disruption, so which means even towards the law, none of us, Governor, has spoken about law, but there should be as well a certain understanding when it comes to disruption, or how to bring it in, and what could be the guidelines, and how to implement the nationwide technologies that are upcoming, and they are there. So should it not be any advice to the government on the implementation? And shouldn't that be a call to the companies or the ones who's busy with such a thing so that it can be anticipated so that it can be controlled? So that's type of suggestion, but question as well. And what is the take of the SARP when it comes to the disruption that's taking over? Thank you.
Thank you. Witness, you're going to go first. I've answered this question about extending of the mandate so many times. So either I can't explain it well or I am not a very good teacher. But I do have a very good teacher next to me here. And he is going to explain that to you and also explain the tools that are used to achieve the mandates. And trust me, when he is done with you, you will understand what we are talking about. Fundi, I think that question was about bank failure in the US and how it impacts it. That seems to have you and your name written all over it. And Kuben, do you want to deal with this? Do you want to deal with this just energy transition and technology and reparations and those things? Try if you do not have enough, we can always ask the teacher to come in. Witness?
Thank you, Governor. So the question on medical insurance, the way we look at it, we look at both the contributions, but also the services costs related to health. So I would say it's a combination of both the contributions, but also the services costs that are associated with medical services. But Governor, I wanted to ask, I don't know if the questions from Mamoket were answered, Governor? Okay, all right. So Mamoket, I think you asked whether, or in terms of our assessment of the impact of load shedding, whether we consider the RAND effect. The simple answer is no. These are direct costs. So essentially what we do, we look at the additional costs of generating electricity during load shedding times, And then we try to make some assumptions about pass-through, which we use 90% of the costs are being passed on to the consumer, so there is no indirect effects at all. So I would say that on that part, the answer would be no. And then the second question you asked was on the impact on the output gap. Yes, I think there is an impact because load shedding affects, I think one of the governors here mentioned, load shedding affects both potential and actual GDP forecast. So as a result, it does affect the output gap. So the way to read the output gap that we are projecting is to assume that it includes the effects of load shedding. So for this round, yes, it's included in the output gap. So, Governor, I think that's all I have to say. Thank you. Yes, I think thanks for the. So I don't know if one of our colleagues, maybe Jeff, is online, or Dineo, who could respond, add additional sort of points on the health insurance. But yeah. If not, we can try to respond, give you more detailed answers on email.
If he's not online, we will give it to Pam, don't worry.
Okay.
Can you get the microphone to Pam?
So perhaps, Governor, while Pam is gathering her thoughts, or we find other colleagues, I can tackle the question on bank failures and the risk of mass withdrawals. So just to highlight the following about the way the system is set up. So we've got the Prudential Authority that is under the umbrella of the South African Reserve Bank, and there we look after individual banks. And we monitor and we assess the health of banks individually. But the SARB more broadly has got a financial stability mandate. So today we are launching the monetary policy review, but we also have a financial stability review document. And in there we highlight broader issues that relate to financial stability. So an incident such as a mass withdrawal, if it were to happen where depositors decide they don't trust all banks and they want their money out, depending on the type of bank or if it's widespread, it might trigger a financial stability event. There, the governor has got, or the SARB has got certain powers that would be triggered in order for us to manage that. But I do want to say, because we can't talk in theory, is that the SARB does have wide-ranging powers to monitor what is happening within individual institutions, and we also have got wide-ranging powers if there are events that might have systemic implications. We have recently had extended powers. So at the moment when there's a bank failure, let's assume there is a problem in a bank tomorrow, every depositor wants to deposit or wants to withdraw their funds from the bank. Obviously that bank cannot continue on a sustainable basis. So at present, the only measure we have is bank curatorship. You would have seen announcements where the Minister of Finance would place a bank under curatorship. But at present, now from the 1st of June, we are going to have wider resolution powers that would allow similar things to what you might have seen in other countries getting triggered as well and enabled. We have a new deposit insurance corporation that is being set up. So Deputy Governor Naidu, to my left, is the chair of the Corporation for Deposit Insurance. It will come into effect from next year, on the 1st of April, 2024. But the processes for setting up deposit insurance in the country have started. There will be broad communication that will come from banks that will highlight how deposit insurance will work for their depositors, and we ourselves as the SARB would be communicating as well. I should highlight, however, that deposit insurance only insures a portion of deposits. What is important is to keep track of the health of the system as a whole, but there are mechanisms for us to manage a situation where there to be mass deposits in the country. So that's as best as I can go in this platform. Happy to answer follow-up questions, should they arise.
Okay. No, Governor, we are sorted with the medical aid question. You just wanted to know what was measured within the medical aid inflation, so I'll explain that. We'll chat during tea time. Thanks.
Yeah, I'll just add my 2 cents worth to the medical prices. In the CPI, what makes it to the CPI is a certain threshold of expenditure. So all households spend much more on medical aid, so the predominant item in the CPI is medical aid. However, when statistics wants to construct real prices for medical value added, they separate hospital, the hospital side, the hotel side, versus doctor's fees, versus medicines and so on. That more comprehensive part is very much part of the GDP and less so part of CPI. On the question of employment, I think it's right for the public to ask us about the impact, the role of the central bank in employment in a country that has high unemployment rate and high inequality. It is a perfectly legitimate question. But I think that, we all know that what makes an economy grow is a suite of policies that somehow have very specific instruments that target very specific parts of the economy. So in order to get employment going, you've got your macro side, you've got your fiscal policy, you've got industrial policy, productivity, you've got an enabling environment through municipalities. So the driver of employment is not monetary policy. The driver of employment is many policies, trade policy, and a variety of other things. But I think when the Fed, for example, looks at employment, an important characteristic of its policy is to determine whether growth in employment is an indication of whether the economy is overheating or whether there's slack in the economy. And that is really the essence of it. The essence of it is to be able to determine what is the labor market telling you about the economy. So if the unemployment rate goes up above, to add complication, we call it a natural rate. We can explain that at T. If the unemployment rate goes above the natural rate, it's saying actually, that there's slack in the economy and maybe there's scope for monetary policy to loosen a bit. If the unemployment rate tightens, it says maybe there's scope for monetary policy to tighten because the economy is overheating. But we do it in a different way. We have a concept called the output gap. We say that if the economy, we have a negative output gap, it's the same as the Fed saying, the unemployment rate is higher than its natural rate. So there are different ways of looking at it. So in our case, the model is very much calibrated that if you have a negative output gap, the interest rate path is very different from that. So at the end of the day, what does monetary policy do? It stimulates aggregate demand when there's slack in the economy. That creates a bit of employment. It suppresses aggregate demand when the economy is overheated. That creates a bit of unemployment, and that's what it does, and that's the relationship. You can play around with concepts. At the end of the day, the bottom line is that monetary policy is a stabilizing tool. It doesn't create employment. It gets more complicated about long-term effects of excessive tightening or excessive loosening. As to whether we need instruments outside of traditional banking, Those instruments have to be looked at somewhere else. Central bank does what it does best. We have to think of innovative ways of getting employment up. We've got to think of improving the efficiency of firms being able to set up in the economy. That's the uniqueness. Those instruments that we're talking about, there's not much the bank can do. I know that historically there was kind of credit allocation that the central bank played, but I think that, you know, the economic policy experience has moved on from that for a variety of reasons. Thank you.
I know Chris is online. I hope he's enjoying it. I don't know if he has got anything to add. I'm sure, Chris, if you've got something to add, you can always indicate. But thank you very much, Rashad, for that. Something just struck me. I mean, if we think that maybe the central bank should be given an employment mandate and then it should create jobs, it doesn't sound very different from a call that government must create jobs. And that's wrong. Because governments don't create jobs. Businesses create jobs. And if we want jobs, we have got to make sure that businesses are created. And if we make the environment of businesses difficult and businesses can't function, businesses can't grow, then you can't have jobs. If governments want jobs, governments must make it easier for business to operate, because it is through the creation of businesses that jobs are created. And so we are stuck in this thing, so government must create the jobs, and then now, okay, the Reserve Bank has been so successful bringing down inflation, maybe let's add jobs to it, or they've been successful in inflation, let's add some green transition to it, and maybe, because then that maybe works, why can't we add poverty to it? Maybe let them deal with poverty and so forth. But maybe we need food security, let's add agriculture to that. Before you know it, you have created a monster that you do not understand what its purpose is. Thank you very much. Nimrod, do you want to say anything before, can I bring this to the close? And thank you very much for joining us. Outside, you will find this book. It makes very, very good reading. It does explain lots of the stuff, and I have got to thank you for your attendance and for bearing with us. We were supposed to finish this session at 6, and we have gone on until 20 past. But Ketiwe, is there anything else? Nothing? You good? Thank you very much. The meeting is adjourned. There are some refreshments outside.